Hi, I'm Lindsey with Global Markets Intelligence at S&P Capital IQ. In January, 2015 earnings growth was expected to expand by 7%. But as the year progressed, earnings growth deteriorated with each passing quarter, as actual growth was weaker than expected and was also tracking lower than each preceding quarter. In fact, the fourth quarter is expected to mark the bottom for EPS growth with a decline of 4.5%. Now, 2015 earnings growth is set to decline 0.7%. As far as leadership is concerned, domestically focused sectors including healthcare, telecommunications, and consumer discretionary are driving 2015 growth, not the cyclical sectors that were originally expected to lead, which included the financials and materials sectors. The key driver of downside pressure on this year's earnings has been the reduction in top-line growth. Sales at the start of the year were expected to expand by 2.5%. Now a decline of 2.2% is expected. Margins, on the other hand, have impressively held steady, only declining by 21 basis points to 9.8%, which is still a historically high level. Looking forward to 2016, growth is expected to rebound to 8% for earnings per share of $126.42. That's very close to the initial 7% growth rate expected at the start of 2015. What's more, the consumer discretionary, materials, and financial sectors are all expected to drive growth in 2016, just as they were expected to lead 2015. The current thinking is that consumer spending will remain robust in the year ahead, driving economic growth and benefiting the discretionary sector. A rising interest rate environment will benefit financials, and materials will rebound from a low base as commodities first stabilize and potentially recover amid a generally improving global economic environment. However, will that in fact be the case? Until next time, I'm Lindsey Bell with S&P Capital IQ.